It's Brian Preston, the money guy.
Here we go. Here's you're ready for the next question. This one is from Jacob. What's a good strategy to strike a balance between mitigating risk and holding your company stock, parentheses, that you believe in long term, when it makes up a moderate portion of your overall portfolio? So it sounds like Jacob must be someone who has either an employee stock purchase plan or has RSUs or options, or maybe the matching in his 401k happens in the form of company stock. How do you balance being very bullish and very comfortable and very excited about the future growth of your company stock, but also not taking on too much risk? How do you navigate those two?
Yeah, there's some backdrop things you need to first understand is that you figure out how you feel about your company. Is this a 5% of my total net worth or is this a 10% of my total net worth? We get nervous. You get in danger zone once you're over 5% of your net worth is not only in your human capital where you're getting all your W-2 wages and so forth, but also all your investment capital is there. But also understand there's unique circumstances where people work for, really fast-growing technology, biotech, other really, there's a bullish opportunity in the long term. Maybe it pushes you beyond 5%, and that pushes me into this second planning thing that you need to understand. Are there some unique tax benefits that I can go deeper into 5 to 10% ownership because maybe I need to hold this for 12 months if we're talking about like RSUs or other things that give me a much or employee stock purchase plan. These things, it doesn't make sense to start just flipping them if there's a tax smart strategy. Or, and this is I'm going to let him do the cleaning up on this because I did the first cut. He's going to come in with the implement and cut the wider cut, is that maybe you really do need to be careful more of the balance between what am I risking by having too much in one employer. Yeah,
so sometimes you can control it and sometimes you can't control it. Because I think most of us, when we work for an employer, we feel pretty good about it. I mean, we would not likely work there unless we had an affinity for it and thought that they were doing good things and thought that they were moving in a positive trajectory. So I think one of the things we have to always be aware of is that we probably have a little bit of home bias when it comes to our employer. We think that our employer is the one that has the technology that's going to change the world or that's going to be the first to market or that's going to fill in the blank. But time has shown us over and over again that's not always the case. I mean, we can talk about all kinds of things that happened back early on in your career with major corporations that people were super excited about that did not turn out because of all kinds of different misdealings. Well, if you had all your wealth tied up in there, even though you may have been gung-ho 100% for that company, things outside of your control could have very much impacted your wealth. So I think what you have to do is you have to have a strategy around what's my current exposure to the company? What is the future exposure coming in? If I am an incentive receiver, am I getting more options and more RSUs? Or if I have unvested holdings, or if I'm going to continue participating in the ESPP, I'm basically on this treadmill, right? So one of the things about being on a treadmill is some of the new treadmill has to come on. That's the future stuff. You have to make sure some of the others falling off, or else you're just going to be stacking and stacking and stacking and stacking in the background. And what once was 10% of your total portfolio can very quickly become 20, 30, 40% of your portfolio. You ought to have a strategy on how you begin to reduce that, how you begin to build wealth outside of that single concentrated holding.
My experience share, because you alluded to it, was that, and what's funny is probably a lot of you, if you're younger, I'm going to say a name like Lucent Technologies, and you're like, what company was that? And I will tell you, any of the excitement you feel now for the Googles, the Netflixes, the Apples, and those things, back in the early 2000s, you would have felt that way about Lucent Technologies. But I'm telling you how short our memory and attention spans are. Lucent was based in Atlanta. The firm I previously worked with a lot of Lucent executives, and I can tell you that every one of them thought that their stuff, this to the moon is not new to this generation, by the way. Every one of those Lucent executives thought they were going to the moon too. And no, a lot of seven-figure wealth evaporated overnight because some bad policies. Because remember, I've said this on this show and I've said it on other shows, horrible news. It's an extrovert in the fact that you always see market volatility, you will see bad real estate marketplaces, and you will see bad unemployment and job work experiences all happening. Why do you think they say misery loves company? So just make sure that you have a plan, even if you're working for one of those high flyers, because they, what fangs, whatever, all the cool sayings that everybody has about the hot stocks of the moment, they too can become the Lucent technologies of the future.
Right.